Good evening, friends. On behalf of Banking Quest, I, Tilak Gulati, extend you warm welcome. Friends, in this training program on risk management in banks and NBFCs level 2, today we are going to have the 9th session. We had already covered understanding financial risk by Professor Rajesh Mahajan, credit risk in corporate finance, including working capital analysis by Mr. S.S.N. Murthy, credit risk in project finance by Professor Rajesh Mahajan, calculating credit risk weighted assets under standardized approach by Mr. S.S.N. Murthy, liquidity risk measurement by applying flow approach and stock approach by Mrs. Shashikala Ramachandra, analysis of interest rate risk by Mr. S.S.N. Murthy, operational risk framework by Mrs. Hemlata Mohan, introduction to financial markets by Mr. Hargovind Sachdev. Friends, today we are going to have deliberations on return and volatility measures. I am happy to announce that we have with us Professor Dr. Sanjay Basu. Professor Sanjay Basu has a master's degree in economics from Calcutta University and Ph.D. from Indian Institute of Management, Calcutta. At present, Professor Basu is Associate Dean Research at National Institute of Bank Management, Pune. His areas of specializations are bond portfolio management, ALM, and market risk management. Professor Sanjay Basu has published a number of papers in reputed national and international journals. So I welcome you, Professor Sanjay Basu, sir.
So before I discuss volatility, let me spend some time on distinguishing between two kinds of returns. Arithmetic returns or simple returns and logarithmic returns. Logarithmic returns are more popular in finance and risk management across the world. But even before I differentiate between simple returns and logarithmic returns, we need to ask ourselves why we need returns at all. So this is some data which I have already shared with you. Now, before I calculate simple, more complicated volatility measures, right? Our purpose is to forecast profits and losses, as we always do in risk management, losses rather than profits. Why don't we? Right? You can answer the questions on chat box, or you can speak up. So, why don't we take the difference between the prices? Why do we take percentage changes? Returns. We do that always and everywhere. For instance, we take returns when we calculate equity beta, percentage change in price for a 1% change in the equity index. We calculate returns when we think of modified duration, percentage change in bond price for a 100 basis point change in yield, right? We always take returns. Take percentage changes, right? Why do we take percentage changes?
Sir, I think because different factors are responsible. So to compare it some other, a benchmark should.
Returns are comparable. Returns are comparable across securities and over time. Let me give you a simple example. Right? I buy Tata Motors at 100 rupees, sell it at 130 rupees. I buy a share of Reliance Petrochemicals at 200 rupees, sell it at 230 rupees. A 30 rupee gain on both deals. Which one is a better deal? Tata Motors 100 to 130, Reliance Petrochemicals 200 to 230. Which one is a better deal?
Tata.
Yes, 30%. 30%. That's why returns are useful, right? So returns are also comparable over time. Between day 1 and day 2, the price of Tata Motors falls from 30 to 60. Between day 2 and day 3, the same price falls from, between day 1 and day 2, the price falls from 100 to 80. Between day 2 and day 3, the price falls from to 60. Which one is a bigger drop, 100 to 80 or 80 to 60?
50 to 60, sir.
50 to 60, 25%. 25%, you are absolutely right. So percentage changes or returns are comparable across securities and over time. Right? Now, very often, when you look at finance textbooks and much of the literature on finance, you will see simple returns. Right? The title of this session is Returns and Volatility Measures. So you will not see simple returns like these. Instead, you will see returns like these, logarithmic returns. Is there any reason why we use logarithmic returns instead of simple returns? So the reason why we use logarithmic returns instead of simple returns, let me show you. The first reason is if there is an accidental input error and to insert a negative price, for instance, by mistake, okay, you see logarithmic returns will return an error term. This is the first possible check. But simple returns can still be calculated no matter how strange they look, whether prices are positive or negative. So you know, negative prices do not make sense. So log returns are not defined for negative prices. I inserted one negative price and the entire series based on log returns began to generate error terms, began to flash error terms, right? So, right? The first reason for preference of log returns instead of simple returns is that any accidental error, right, of a negative price, right, will be caught by log returns. You will understand you have made a mistake, right? To insert one negative price here, right? And this column will throw up error terms, but not this column, right? Simple returns can be calculated with negative prices, but not log returns, because logarithm is not defined for negative prices, right? Suppose I'm in FX and I want to calculate changes in say Mexican peso, rupee by peso. I can split this into log of rupee by USD minus Even if, forget this, even if I do not have a direct quote, follows from the rules of logarithm that I can convert an indirect quote into direct quotes. Right? I can create, even if I do not have an exchange rate from the market, I can create this exchange rate based on direct quotes. This is not possible with simple returns. Finally, this can be expressed as so. If I want to calculate returns over a longer horizon, for instance, in the polar value at risk measure, we often calculate 10-day returns, right? It is not necessary to take 10-day changes in price. I can take 10 daily changes in price and add them up. In this case, two-day return is the summation of daily returns. So logarithmic returns are additive over time. Logarithmic returns can help us break indirect quotes into two direct quotes. And logarithmic returns do not admit negative prices. Right? For these three reasons, we prefer logarithmic returns instead of simple arithmetic returns. Now, once we take these returns, so we do not need simple arithmetic returns. So what do we do? Very often, we are asked to compare the risk profiles of two different securities. So how do you compare the risk profiles of two different securities? Right? So what we do is we calculate means of these securities. So therefore, we calculate the average return. So since this is daily data, the average is close to 0. Then we calculate the deviation from the average. This is the deviation from the average return. Now the problem is, very often, positive deviation can cancel out a negative deviation. The overall deviation from the mean may be very close to 0. So it may appear that the overall fluctuation is very limited because a positive deviation from the average return cancelled out the negative deviation, right? So what we do is we square the deviations, right? So that the sign does not matter. And larger deviations get greater weights. Okay? The sign does not matter and the larger deviations get more importance. So therefore, we add up the sum of the difference squares, right? The squares of the difference are summed up and we divide it by the sample size minus 1 and take the positive square root. If we do not take the square root, we call it variance. Once we take the square root, we call it the standard deviation. Right? The standard deviation, another way to remember the term standard deviation is root mean square deviation. So that tells you all the steps that are involved. First, you square the deviations so that positive and negative deviations do not cancel out each other. Right? Then you mean divided by the sample size minus 1. Right? So, square and mean are already accounted for. Then you take the positive square root. So root means square deviation. This is exactly what your Excel formula also does. This is manual. What I have calculated is manual, right? This is what your Excel formula also does. Okay. So therefore, now a comparison of risk profiles somewhat easier for you. If I ask you, ladies and gentlemen, between these two securities, 3,000 US dollars and a basket of Nifty, right? The most traded, the most liquid shares in our country, which position is riskier? To compare these standard deviations. So the computation of standard deviation here is the same as in the previous sheet. I showed you for one, so I do not show you for both. Right? So this instrument is almost 3 times as risky as right? Very often what we also do, what is the volatility relative to the mean? So you may say that for equities, my mean return is higher. So I'm willing to take higher risk as well. So we often compare standard deviation as a proportion of the mean, the ratio of standard deviation to the mean, which is called coefficient of variation. Right? So here you can see the standard deviation is 27 times the mean, the daily standard deviation. This is daily data, ladies and gentlemen. So therefore, here the volatility matters more. Right? For high frequency data like daily data, very often in finance, we ignore the average. The average return is very close to 0. What matters is the volatility. Volatility is 27 times the average return. This instrument is riskier because the volatility is 28 times the average return. Therefore, right, even while you claim that you get a higher expected return or average return on Nifty, the volatility is much higher even after you take account of the average return, right? 28 times the average return, and this is 27 times. Okay, now you try to convince. So the standard deviation is a very convenient measure of risk profile across different traded securities, right? A very popular measure called value at risk was built on standard deviation to begin with. It was called variance covariance. I'll come to that. So standard deviations are comparable, right, across all securities. You need not. Therefore, it also solves another major problem, right? Often you find it difficult to compare the risk profiles between bonds and shares, because bond risk is estimated with duration, modified duration. The risk profile of shares or stocks is estimated with equity beta, right? The use of standard deviation makes the risk profiles comparable. You can estimate the standard deviation or the coefficient of variation, right, for bonds and shares, because you use the same tools. You compare apples to apples. The results are comparable. You don't compare apples and oranges. Okay. Because the results are comparable, now suppose you try to convince the equity trader, look, sir, the standard deviation of your position is more than twice the standard deviation of currencies. You better be careful. The equity trader may laugh at me and say, but sir, high standard deviation or volatility has pushed up prices from 9105 13558, right? So therefore, for the last 3.5 years, high volatility has pushed up prices of my Nifty portfolio by more than 1.5 times. Why should I be careful? High volatility has pushed up prices in the past and yet may push up prices in the future, right? Where is the risk? From your own experience, ladies and gentlemen, you know positions which rise fast also fall fast. But standard deviation does not indicate the direction of the shock. That is because you will recall in the previous sheet, we had squared differences. Once you square the differences, remove the signs. So a high standard deviation informs us that prices are likely to change to a great extent, need not alert us to a price decline if we have a long position or a sharp rise in prices if we have a short position. So the first problem with the popular concept of standard deviation is that it does not capture the direction of the shock. It does not alert us, right? If we take these as, right, indicators of future price movements, we do not know whether prices will rise on an average by 1.24% each day or fall on an average by 1.24% each day. Right? Why have we used standard deviation? Because we believe that historical volatility will continue in the future as well. Right? Daily prices have risen by 0.35% on an average, right? Daily prices have moved by 0.35% on an average around the mean, which is very close to zero, right, in the past. So we believe that the volatility between today and tomorrow will also be 0.35%. We believe here that the volatility will be 1.24% between today and tomorrow, just as we had seen every day in the past. But we do not know whether prices are likely to rise or fall. That's the first problem with standard deviation. Right? The second one, right? So standard deviation, right, does not capture the direction of the shock. The second problem, even if the bank holds capital to absorb a daily shock of 1.24%, let's go down. You can get a shock of 0.35%. What if the Nifty falls by 2.35%? Or by 0.41%, 0.7%, right? Or by 8.67%, or by 5.02%, or by 3.78%, as had occurred in the past. Standard deviation, in other words, is an average measure of shock. It cannot capture very large positive or negative shocks. So we say root mean square deviation. It is the mean that hurts here. Standard deviation underestimates very large market shocks, which may lead to insolvency or bankruptcy. So, even while standard deviation makes the risk profiles comparable, right? It does not capture the direction of the shock, right? And standard deviation as a measure of volatility does not capture extreme shocks. Okay, very large positive or negative shocks, which may lead to insolvency or bankruptcy, right? So these are the two Main problems with standard deviation. So far, am I clear? Any questions at this stage? Am I audible? Am I clear?
Yeah, you are audible. Any question, friends?
Dr. Basu,
Yes.
may I ask one question, please?
Yes, sir. Yes, sir. Please.
So, when we are talking about the standard deviation as a tool to measure the volatility,
Yes, sir.
as you have told that the constraints, first, it is not providing that direction, and
Yes.
second, it is not helpful in absorbing very big, indicating very big losses.
Yes.
So, do you think that that is why the stress testing is required?
Yes. Yes. And that is why, right, you will be familiar with historical simulation. Right.
Yes.
That is why the market has shifted from variance covariance to historical simulation. Because historical shocks are found to be much bigger if the sample is well chosen than volatility based shocks. Okay. That is one reason for stress testing. Right. Even under stress scenario, standard deviation cannot pick up very big shocks. The other reason is that is why the market has shifted towards historical simulation or Monte Carlo simulation based models, which are better equipped to capture bigger market shocks and indicate the direction of shocks as well, both. Any other questions? So all of these are given in the PPTs, right? I do not follow PPT word for word. That's not the way I teach. I love to take an example and take you through that example so it is easier for you to follow, right? The PPT has been shared with you. All of these, including the formulas, are given in the PPT. Okay. Now let me come to portfolio volatility. So these are the returns whose standard deviations or volatilities we calculated, right? So we presume that historical volatility as calculated from return data will continue into the future as well. So for this two asset portfolio, what is the portfolio volatility? Should we add these volatilities? This is the first. Right? Should we take the weights and add these volatilities? Right? So what are the shares of the two instruments? So we see that 44% of the portfolio comprises USD and 55% comprises. So this is 45, 44.8, that's 45, this is 55. What is portfolio volatility? In order to estimate portfolio volatility, so W1 square, sigma 1 square, right, where sigma is the standard deviation, W2 square, where W is the share, sigma 2 square, 2 into correlation. Why is it necessary to insert correlation? Because that captures the strength of the diversification benefit, the presence or absence of the diversification benefit. Right? Give you an example. Right? When equity markets tend to decline across the world, as they did during the global financial crisis as well, during the COVID-19 pandemic as well, right? Many large investors tend to hold precious metals like gold and silver, especially gold. Now, gold has very high volatility, but gold is treated as a classic hedge because it is negatively correlated to equity markets. So when equity prices crash, gold prices spike. Had they been positively or strongly correlated, both gold and equity prices would have crashed together. Investors would have faced a double loss, a double whammy. But both gold and stock markets exhibit high volatility, but move in opposite directions. Right? Because they move in opposite directions, a loss on one is offset by a gain on the other. So that is captured. So the overall portfolio volatility is muted, right? Or controlled by the correlation. The lower the correlation, the more negative the correlation, the higher the diversification benefit in the portfolio. In other words, the lower the portfolio volatility. One instrument shoots up, the other instrument crashes. So the crash in one position is offset by the spike in the other position. Right? Gold is a classic example here. Okay. So as equity markets crash, equity markets decline, gold and silver prices tend to shoot up. As a result, the overall portfolio volatility, right, is medium. Right? So therefore, the portfolio volatility must consider not only the volatility of the individual instrument. That's why we invest in a mutual fund. That's the purpose of a balanced mutual fund. Right? You have some risky instruments that give you high returns. Right? Balanced by some safe assets which give you steady returns when those risky instruments crash. Right? That is the whole point of mutual funds. The assets are not very strongly correlated to each other. They are not very strongly positively correlated to each other. Any questions before I move on to my last topic? Any questions on the items that I have discussed so far? So I have told you how to compute individual standard deviation or volatility, why we square, right? What are the merits of standard deviation or volatility? Comparability across instruments. What are the demerits or shortcomings, weaknesses? And how we combine volatility across different positions to arrive at portfolio volatility.
Professor Basu, I would like to ask one question. Can I?
Yes, yes, please, please. Your name, sir.
Yeah. See, actually, we say that a liquid, in generally a liquid market, actually, it follows a normal distribution. So in which case, actually, when you calculate historical value at risk, as well as value at risk based on variance covariance, won't it be congruent?
Variance covariance assumes a normal distribution.
True, but when you actually basically compute in a liquid market, for instance, forex market, when you actually compute historical VAR, basically because actually the market.
Yes, the more liquid the market, I agree with you, the closer will be the results of historical simulation and variance covariance. Because the more liquid the market, the smaller will be the bid and ask, right?
Right.
Therefore, prices will tend to follow a normal distribution. Returns will tend to follow a normal distribution, right?
True.
So therefore, I will modify your response to a certain extent, right? In a very, very liquid market, right? Which is the starting point of a normal distribution. No transaction costs, free entry exit, right? Ability to buy and sell very small units, right?
True.
Which are indicators of liquidity. Okay. So therefore, in a liquid market, historical simulation VAR should be very similar to variance covariance VAR. Variance covariance VAR makes an explicit assumption of normal distribution, which historical simulation doesn't. But as you pointed out, right, a high degree of liquidity indicates a normal distribution.
True, sir.
I agree with you. What's your name, sir?
I'm Shankar Narayan, sir.
Shankar Narayan.
Yeah, sir.
Yes.
Sir, one more thing I would like to ask you. Actually, we have also use various methods to measure tail risk. So, are we not using as a measure of standard deviation to measure tail risk also? So, if extreme movement actually is not getting captured through standard deviation,
You will now come to a measure of standard deviation, which can be updated to capture extreme movements.
Right.
That is your exponentially weighted moving average, a more sophisticated form of which is called GARCH.
Okay.
Now, right. So, how do you calculate? How do you calculate exponentially weighted moving average? What we do is, to begin with, we must start with something. So we assume that the variance for tomorrow will be equal to the square of the returns for today. Right? From that point, we start. This is my starting point. What should be the variance for day after tomorrow? The variance for day after tomorrow is a weighted average. It's a weighted average of yesterday's variance, right? The weight is called lambda, which is how much importance do you assign to yesterday's variance? Here you assign 94%. So you believe between today and tomorrow, 94% of the time, yesterday's variance. Sorry. Hold on. Hold on, please. 94% of the time, yesterday's variance will prevail. But with a probability of 6%, right? The events between yesterday and today will affect my volatility. This is where your question arises, right? So this was thought of by researchers. So suppose yesterday there was a big market shock, right? Say the market moved by 4%, right? Or 5%. So you can see there is a very big jump. Right? So the bigger the shock, the bigger the recent shock, so suppose the market fell by 10%. 15%, as happens during a large devaluation. The Thai baht crashed by 25% on a single day. So this method, right, known as exponentially weighted moving average, helps us capture sharp spikes in recent volatility and adjust our volatility estimates in line with large market movements. Right? So, is this clear? Is it visible that the bigger the recent shock, if this is, say, 25%, the bigger the recent shock, the higher the volatility estimate. Is that clear, sir?
Actually, can you just explain to me that realized volatility and predicted volatility, how you have calculated? Just
realize, okay, do not look at this. Do not look at this column. For the moment, forget this column. Let me hide this column. This is not relevant for you. Okay. This is not relevant for you, right? I will unhide it, time permitting, right? Because that is relevant for calculation of lambda.
Okay.
So lambda captures your belief, the strength of your belief. How strongly you believe that past volatility will continue in the future. So here, you are not 100% sure that past volatility will continue in the future. For 94% sure. So with 94% probability, right? You presume that yesterday's volatility will continue tomorrow as well. What has altered your view is that there has been a large market movement. You can see this, right? So therefore, there has been a large market movement, okay, for which I need unhide that, right? There has been a large market movement, right? So this realized volatility is nothing but the square of returns. Okay. So therefore, Mr. Shankanarayanan, right? Let me ask you a question. How will you know that your volatility forecasts are correct? What does volatility capture? Future movement in prices, right?
Right.
So therefore, what is a future movement in price? We just saw that this is nothing but return.
Okay.
So if your predicted volatility based on standard deviation or some other formula is close to the square of the returns, right? Then you say that my prediction, my variance prediction, right, is able to capture the future fluctuation in prices. The actual fluctuation is captured by returns, isn't it? Which you want to forecast beforehand.
Basically, it's the past data. Realized volatility Basically,
realized volatility is future data. So therefore, hold on. I have made, yes. With this prediction, let me clarify your question. Can I go back even further? No, I can't go back further. So this is a prediction forecast tomorrow's volatility. This is a prediction for this volatility. Okay. So just as you backtest VAR, you must have seen, right? We backtest VAR with actual P&L, isn't it?
Basu?
Yes. So therefore, you predict volatility using historical data, and you compare it with, let's open up, you will realize. You compare the square of returns with predicted volatility. You compare here. The volatility that you predicted yesterday with the square of the returns that you got today. The square of the returns is the actual. Your volatility prediction used past data. Is that clear?
Yes, sir.
This is what you do. You predict one day before and you compare it with the actual price movement or return today. You predict VAR one day before and you compare it with P&L today. Right? The same logic.
Okay.
Okay. And
Okay.
what I was able to show you, when you get your volatility estimate based on what has happened in the market between yesterday and today, the bigger the market shock between yesterday and today, the bigger the volatility estimate. You know, that is the benefit of this method. This method, let me show you the difference. Instead of, say, 4%, if I put 10% here, a very large shock. In simple standard deviation, if I change one shock, you see my volatility hasn't changed much. Volatility hasn't been updated. I changed one big shock to 10%, but it got lost in so many data points. Right? It was 1.24, it has become 1.28. But if I change one data point here, as I did, my volatility estimate gets a very big jump. This is because this data point gets much more importance, much higher weight compared to each data point in simple standard deviation or volatility. So therefore, we use EWMA or GARCH if our intention is to capture the impact of very large recent market shocks. Right? Professor Mahajan referred to stress tests. You can use EWMA, exponentially weighted moving average, or GARCH, based volatility or standard deviation for stress tests, but not simple standard deviation. Am I clear?
Yes, you are very clear, Dr. Basu. My one more question is,
Yes.
when in a portfolio, there are two securities,
Yes,
the
sir.
direction may be proportional and direction may be inverse.
Yes.
So,
That will be captured by correlation.
Correlation. So is there any correlation coefficient we can establish by regression or correlation method or any other method?
Yes, sir. That's what I have done. The Corel formula will give you, right? So therefore, you can.
So according to you, how much data it should be taken for a 1 year, 2 year to capture the proper correlation, or?
Sir, Basel says 250 days.
250 days. So that is for the historical simulation.
No. That is for all VAR methods.
All VAR methods.
All VAR methods, sir.
Okay, all VAR methods.
At least 250. But that's a very good question, sir. Can I expand on that a bit? The reason why I have not taken 250, why I have taken much more than 250 is an art rather than a science. The reason is within the last 1 year, not much may have happened. The market may have been unidirectional. The market may have been either too calm or too volatile. That is why it is advisable to take an entire economic cycle, right? Where you get both positive and negative movements. Over the last 1 year, both the markets may have moved in the same direction, or none of the markets may have moved much. So that may not give you the true picture in the future. That is why at least 250, sir.
Then Dr. Basu, my question is, when we say with the confidence level 99% or 95%.
Here so I have not discussed that.
No, right. But then what is the sensitivity of this confidence level? In case if the 250 days data is not able to capture the full economic cycle and we are predicting for the future, and future depends upon the emerging economic conditions or the other microeconomic factors, right? So how we can basically take into account the future possible indicators, macroeconomic or other factors to correctly, predict the estimates.
So that is why, sir, it is not advisable, in my opinion, to take exactly 250 days. 250 days, that is why human judgment is also very important. There are complicated econometric methods to forecast, right, arch, garch. But I think the most important, like the choice of your stress period, what is the nature of your portfolio, and when did such a portfolio face a major stress in the past? Only your judgment and knowledge of markets will tell you that.
Dr. Basu, my question is basically because many of the participants may be from the mid office of the Treasury, and there basically we.
So there is no hard and fast rule, sir. In my opinion, there is no hard and fast rule.
No, my question is different. My question is that when we are fixing the risk appetite about the portfolio, and that risk appetite of the trading portfolio, trading books.
Yes.
So arriving on that, we are normally taking 250 days with a 99% confidence level and future 10 days holding the portfolio. So based on that, we are fixing our risk appetite. So what you will suggest to all these people, those who are working in the mid office or those who are in the Treasury? So what should be
my simple suggestion is, before you choose 250 days, make sure that the phase of 250 days captures both positive and negative shocks. Eyeball through the data, glance through the data. Your knowledge will also help you. Your market knowledge will also help you. Right? So the COVID phase may have been turbulent, but the phase before that may have been calm. So if you ask me, to be very honest with you, Mahajan sir, if you ask me how many data points should I take, Sanjay, I have no hard and fast answer.
Right. No, that is understandable. So I think you want to suggest to the participants that
it will vary from one data set to another.
It should not be merely a mechanical exercise.
No.
There should be some judgment also.
Yes. It is judgmental. Choice of the data set, right. Is often judgmental.
Right. Thank you.
Any other questions? Any questions? Any comments? Otherwise, this is where I'll stop, because this is what I was asked to cover. From returns to simple volatility, I discussed the merits and demerits of simple standard deviation portfolio volatility, concluded with more advanced measures, EWMA and GARCH. Another name for EWMA is GARCH.
Right, sir. Basically, we wanted to use this session to make a foundation for calculation of VAR under historical simulation Monte Carlo or various covariance in our level 3. So that was the whole purpose. Unless these fundamentals are not clear, so I think discussing market risk is meaningless. So,
yes,
so I think it is purely beneficial to all of us, rather.
Thank you, sir.
Your presence today. Very
Thank
much.
You, sir. Thanks a lot.
Very much. I think we are indebted for this.
I hope it was of value, sir. I hope it added value to your participants.
Yes, sir. Indeed, it added value really, actually. But again, I think the participants
please go through the Excel sheets. Nothing helps you better to understand a concept than working out a problem yourself. PPTs can describe a concept, but PPTs will not help you understand it. That is why I depended only on Excel sheets.
It was enlightening, sir, because you have used the Excel sheet and simultaneously shown us the variations also. So it was that way very enlightening. And thank you so much.
Thank you, Mr. Shankanarayanan.
Thank you.
So with your kind permission, right, can I bring the session to a close, Mr. Gulati?
Friends, any other party?
Any questions? I'll just stop sharing the material.
Yeah, friends, any question? Any other parties want to say anything?
Any other questions?
Yeah.
Sir, Umesh here, sir.
Yes.
Yeah, Umesh.
Sir, just I would request sir to take some basic classes on this concept, sir. I mean, this is we are facing this type of concept first time, this volatility. So if we can have some basics so that, sir, we can understand it properly, sir, actually.
Okay, fine. Okay.
Yeah, we have tried. Yeah, we have tried to make a base for the level 3. So Dr. Sanjay Basu has covered this concept in a very easy and practical manner, explaining everything with example. So yeah, Dr. Basu, on behalf of participants, I extend my heartiest thanks to you, sir. But I would like to request Professor Rajesh Mahajan to kindly say a vote of thanks to Professor Dr. Sanjay Basu. Yeah, any other participant want to say anything, please say it. Then I would request Professor Sanjay Mahajan. Rajesh Mahajan, sir.
Any question? Any question, please?
I would like to only add that if Professor Basu could suggest to our participants some, books that they could go through.
I will share with Mr. Gulati. I will share with Mr. Gulati. some very simple books.
I think already Dr. Basu, he has suggested me few books. So Mr. Basu will also share with Mr. Gulati. I will also share.
I will share with the participants. Yes.
Dr. Basu, I could hear partially your talk, and it was very interesting as usual. Yeah. Greetings to you for the Navratri.
Yes.
To all of you. So, how are you?
Fine, sir. Fine.
Yeah, I was listening to your talk. Of course, I could not listen fully. I will request for the recordings of your talk. But it was very interesting because I just listened a part of it. As usual, the flow and other things were as it was earlier. So good, nice to hear that.
Thank you, sir. Thanks a lot.
Thank you. Thank you, Rajesh ji and Mr. Gulati for organizing this.
Thank you, Dr. Rao. Thanks a lot. Yeah.
Hello.
Yeah.
Yes, sir.
Yeah. Basu, Girish here.
Girish, yeah.
Yes,
Hello.
please tell me.
Yeah. Sir, if we want to go ahead with this advanced learning, so where we can catch you for that? Is there any platform where you are teaching?
I teach at NIBM. You can send me a mail.
Okay, sir. Fine. Thank you.
Right? My mail ID is available with Mr. Gulati. You can send me a mail, sir.
Yeah.
Sure.
So
Okay,
nice, Dr. Sanjay Basu. So nice of you. Yeah.
So in case if there is no further question, so can we go to the last phase of concluding the session? Mr. Gulati, should I propose?
Yes, sir. Kindly, first, okay, kindly you propose the vote of thanks, then we will request Dr. Sanjay Basu to say a few words of advice to the participants.
So thank you very much, Gulati ji, as well as Dr. Sanjay Basu for considering our request. Basically, I know as far as the market risk is concerned, you are the authority on the subject, and we wanted that a person of your stature only in our level 2, because in the case of the market risk, we wanted that there should be some foundation, because at the level 3, as Mr. Girish and Mr. Umesh were asking, so at the level 3, we are going to give a sufficient time, say 4-5 sessions, purely on the market risk and for the calculation of the VAR under the different methods, Monte Carlo, variance covariance, and the historical simulation interpretation of that. But one thing I wanted to suggest to all the participants, in case if they want to be good in the market risk, they should be good in the statistics also. As you might have seen that there is a lot of calculation, and very basic thing is that of the standard deviation. And in case if you can do all this calculation on the Excel, nothing like that. So more and more data you can have, more and more data you can play with. So that is the whole thing which we wanted to bring to all of you, because in the case of the credit risk and in the case of the operation risk, there must not be too much requirements as of now. But when we will be moving to the advanced approaches, there also definitely there will be some requirement of the mathematics. But you have to be excel in the statistics also, in case if you want to learn this. Dr. Sanjay Basu, thanks a lot for your time and for such a lovely session today. We feel very much obliged for this purpose, and it was my basically wish that in our program we should bring in, and maybe possible in our level 3 we will be bothering you much more. So with this things, thank you very much once again.
On the last, I would request Dr. Sanjay Basu to give a piece of advice to the participants how to proceed further to understand this market risk and the entire risk spectrum in the banking industry. Sir. Dr. Sanjay Basu, sir.
Yes. Mahajan, sir. Rao, sir. Mr. Shankanarayanan, Mr. Gulati, Shashikala Madam, distinguished participants and guests, it has been an honor to address esteemed bankers on your invitation on my favorite topic of market risk related to volatility. I tried to keep it brief, to the point, and based on market data and examples, rather than a mere discussion of a PowerPoint presentation, which does not take us anywhere. If you wish to continue with market risk, I would suggest that you start working on different indices, Nifty, CCIL bond indices, right? Based on whatever I discussed in class, try to replicate what I did in class. When you attempt these problems yourselves, you may get stuck. As you find solutions to these problems yourselves, you appreciate the concepts better. There is no other way to learn risk management than to get stuck and solve problems on our own. Right? This is the humble submission, this simple piece of advice, to be honest with you. My background is in economics. I had no prior education in risk management. Right? Whatever I learned was at NIBM because I was asked to teach market risk. I stumbled, I faltered, and I learned. This is the only suggestion I can give you, right? There is a lot of data on the RBI website. There is a lot of data on the NSE website. There is a lot of data on the CCIL website. Try to replicate what I have done, right? If you can do that, you would have learned a lot of market risk on your own, right? Which no books will be able to teach you. Once you understand the concepts, then you go back to the Reserve Bank of India guidelines, books and reference texts, because those guidelines presume some prior level of understanding. Unless you understand the tools and concepts, you don't understand those guidelines. You would be scared by those guidelines. So that's all I have to say. Thank you, ladies and gentlemen, once again for your cordial invitation for this platform. I'm indeed grateful to senior bankers like you, esteemed bankers like you. Thanks a lot for the opportunity.
Yeah.
Thank you, Professor.
Thank you.
Yes,
Thank you, Professor Basu. Thank you very much.
Thank you, Mr. Thank you, Rao, sir. Thank you, Gulati, sir. Thank you, everyone.
Yeah, sir, Professor Sanjay Basu, it is our privilege that you have agreed to come on this platform. On behalf of the entire team of Banking Quest, I express my heartiest gratitude, sir. You have spared time and the participants on this Banking Quest platform. From all our team, I express my heartiest thanks to you, sir.